To be or not to be, this will be a week of reckoning for the South African economy. Second quarter gross domestic product data set to be released on Tuesday will reveal whether the economy is in a recession. In June, the World Bank cut South Africa's growth forecast for this year to 2% from an earlier forecast of 2.7%. South African Reserve Bank cut its economic forecast for this year to 2.1% from 2.6% previously. But the consensus is that the second quarter was not as disastrous as the first. Growth is expected to rise marginally following the drop recorded in the first quarter. Following a contraction of 0.6% in the first quarter, economists expect GDP to register growth of 0.4% in the second quarter. Well, John Loos is housing and property strategist with FNB, and he joins us in the studio to unpack this. And of course, good afternoon to you and welcome.
Hello, Colin.
Well, recession is now the buzzword for most economists, and of course, has it been long forthcoming? Because we had a projection that the economy would grow by 2.7%, and of course, it has been downgraded to 2.1%. And you know what the World Bank did as well at the end of the year? It actually cut the growth forecast of South Africa.
Look, this very weak growth situation has been a long time coming. Since 2011, 2011 growth peaked after the recession, and then since then we've gradually tapered off. 2012 was slower, 2013 was slower, and now 2014 looks like being even slower. Well, the first half certainly was slower. So, you know, it's been gradually tapering off. We've seen a lot of signs of that. We've seen social tensions in the country rising. Strike action in recent years has been elevated. That's disrupted the economy more and more. And now, of course, the interest rate stimulus is withdrawn. We've got to the end of cuts, and now we've actually started the hiking. So, yeah, it's, you know, slow growth has been expected for some time. Whether it had to manifest itself in a recession, that had a lot to do with mining sector strike action, big, long platinum strike, manufacturing disruptions. There were electricity supply disruptions in the first quarter. So there were a lot of things that are very difficult for economists to predict on top of that cyclical slowdown. And that took us into recession in the first quarter. The second quarter is going to be touch and go. There was a lot of disruption then as well. You know, the mining strike went on into the well into the second quarter. Manufacturing has been in contraction for quite some time. So the question obviously is the big sector of the economy is the services sector. We don't always have up-to-date monthly output figures for that, you know, the financial sector, the real estate sector and so on. So the question is, how much did those perhaps slow down? That's the big unknown in our, you know, as to whether we did go into recession or whether we narrowly avoided it.
On the consumer's perspective, can we say that the recent demise of African Bank also is a clear testimony that most borrowers were unable to pay due to unemployment, or they couldn't afford because they hadn't tightened their belts, and of course it was reckless lending on the side of African Bank? Is this a recipe for disaster as well as an attribute towards the reason why we'd be getting into a recession?
Well, I certainly can't comment on African Bank specifically, but you know what I can say is that we are a relatively highly indebted household sector. It's improved since 2009. The debt to disposable income ratio has come down from 83% at its all-time peak to 74.5%. So we're slightly in a better position than what we were 4 or 5 years ago. But it's still by our historic standards a household sector that has relatively high levels of debt. So we don't have much space to move. If the economy slows down and there's, and household disposable income growth is under pressure, or if inflation rises, especially the essentials like food price inflation, we do quickly come under pressure because the savings rate of our population is so low and the debt levels are so high. There's not much margin for error.
Well, just very briefly, of course, we've been having the recent downgrades by rating agencies, and of course, could they also be the attributes to the looming recession and a combination of the forthcoming drop in the petrol price? Can we also say that it will weigh in heavily on the figures that could be released tomorrow?
Well, yeah, I don't know if ratings agencies cause downgrades. They react to economic data. What they do, obviously, when they downgrade us is a lot of funding that comes to, you know, South Africa's way from foreign sources can slow down because a lot of the investors look at these ratings agencies for guidance. So if they raise our risk, it means a slowdown in capital flows. We've seen a weak rand setting in recent years, and that is the economic negative in my terms. So it has an impact, but it's not so much about the ratings agencies doing it. They downgrade in response to a deteriorating economic and policy situation, which has been the case for a couple of years. So it's always a chicken or the egg, but I think they're just moving in response.
Well, I'm interested when you talk about how the economy has been performing now. But looking at the sentiment, there hasn't been any dramatic performance of the markets. There hasn't been, some abrupt or knee-jerk reaction. And of course, the rand has been a little bit stable, trading at around 10.70 against the dollar. And of course, can we say this can actually enhance the sentiment towards investment in the country, as you could predict a slowdown regarding the downgrading of South Africa recently?
I'm not sure that this recent sort of relative stable response to the negative information is necessarily a positive. I think a lot of the negative is just already in the price of the rand. The rand has depreciated quite dramatically since 2011 or so. It's a lot weaker than what it was then. That deterioration coming on a series of sort of steady bad news flows for a while. Wider government fiscal deficit in recent years, wide current account deficit in the country, weakening economic growth. So I think it's more a case of just a lot of the negative is built into the price already, is in the price. The rand is weak, and therefore something like a ratings downgrade, these things have been to a large extent expected for some time now, so it's already priced in.
All right. On the parting shot, what do you expect tomorrow?
I think we might just avoid it slightly. That 0.4% consensus forecast is not far-fetched. I don't foresee too much different to that. But I think the point is we shouldn't really be happy about just avoiding recession, whether it's minus 0.6 or plus 0.4. It is dismal economic growth. It is a problem from a social tensions point of view. If it carries on like this, it's a problem from a stability point of view, because the tensions have been rising in recent years. So regardless of the figure, I don't think it really matters. We're in a very bad economic situation, and it needs something to kickstart it.
I beg your pardon for cornering you. I'd like a yes or a no. Do you expect us to be in a recession when the figures are announced?
Sorry, slightly positive, yeah, as the more or less what the consensus says. So slightly positive, very slightly positive.
All right. John Loos is housing and property strategist with FNB there, of course. Quite a little bit evasive about whether or not we'll be in a recession tomorrow when the figures are announced. But anyway, we'll cross that bridge when we get there.